if you can't afford to live in one of our mobile home communities in that respective whatever market it might be, there's truly not a more affordable option. I mean, you might be able to go find like a studio apartment in the wrong side of town,
Yeah.
and cram your entire family into it. Like that might be an option, but truly meaning like a normal size unit. We are the best, most affordable option. In fact, most of the time, our units are actually nicer.
Hey, everybody, welcome back to another episode of the Richer Geek Podcast. Today we have Kevin Bupp. He is a Florida-based real estate investor, top Apple podcast host. His we'll talk about a little bit about his podcast. He's a best-selling author of the Cashflow Investor. He has over 300 million in real estate transactions under his belt. He has decades of experience. We're going to talk a little bit about, not the normal stuff, but we're going to talk about mobile home parks, parking lots, different type of asset classes. How you doing, Kevin?
Mike, I'm doing good. Excited to be here. Thanks for having me.
Yeah, I love dealing in other type of assets. I can only have so many multifamily people, and I can only have so many fix and flip people. It's like
Yeah.
go away. But mobile homes and parking lots, for those of us that are into real estate investing, I've always heard these great things about mobile home parks. I mean, just my God, they just sit there and make money. We'll talk
Yeah.
about that in a little bit. Give us a little bit of a story. How did you get involved in real estate investing? Who are you?
Yeah, no, sure thing. Real estate kind of found me at the age of 19. I didn't find it, so very grateful for that. At that point, I was tending bar in the evenings, going to community college, trying to figure out what I wanted to do when I grew up, and just happened to meet a local real estate investor through the girl I was dating. She was, or he was dating her mother. So just by happenstance, got to know him, and he really became my rich dad. Is the best way to put it.
Mhm.
I grew up in a blue collar family. Always had enough, but didn't have excess. Right, like just it's all relative though. Like you kind of don't know what you don't know. So,
Yeah.
but it was good. Both my parents worked. Neither had gone to college or anything like that. That wasn't really expected of me either. Just kind of go get a job at the post office, UPS, something like that that's got benefits, and you'd be good to go. And again, nothing wrong with that. Just it just wasn't really ingrained in me. And I knew that if I went away to college, I probably would have partied out the first semester and wasted everyone's money and time. And so
That was
yeah, and
me.
so I just went to community college, but with no direction. I went there and started taking classes, and not really sure what I was excited about, what I wanted to do. Although I had been entrepreneurial for many years leading up to that, I always couldn't wait to work and make money. I had a paper route at the age of 12. Would go shovel snow in the winter, mow grass, wash
Yeah.
cars, and then learn how to install, electronics into my brother and his friends' cars, head units, amplifiers, all that kind of stuff in my parents' garage. I did anything to make money. I just wanted to make my own money so I could buy the things I wanted,
Yeah.
and not necessarily wait till Christmas to get, maybe one of those things, right? Like I wanted to go out, go buy skateboards or BMX bikes or dirt bikes or all that material crap that kids wanted, right? The latest and greatest cool stuff. So, but fast forward, I met David, and David, just I saw a different lifestyle, and he invited me to a conference after a couple months of knowing him, and I was kind of hooked. I was around a lot of people
Mhm.
that are making a lot of money, and I didn't feel like they were much smarter than me. They just knew a little bit more than I did, and
Mhm.
so I essentially, offered to, David was the solopreneur. He owned a number of about 40 units total. He'd been doing it for a while, owned a number of them free and clear, and so he had a pretty good lifestyle, and I just basically offered to come work for him for free. I saw that he had some struggles with technology. He was about 25 years older than I. And he was a single guy as far as like running his business. He wouldn't return calls all that quickly. And it's just there's
Mhm.
areas that he didn't want to have any employees. He chose to work alone, but I saw areas I could help him. And so I kind of said, hey, can I come work for you? I mean, otherwise, like I'm not going to learn this. I would love to add value to you and whatever it might be. And I kind of pointed out a few areas where I thought I could help him. And that morphed into just basically being everything. I would drop two
Mhm.
by fours off at job sites. I would pick up leases. I would go get coffee. I would do whatever. I'd return phone calls, things like that. I would scour MLS listings, do that kind of stuff. And it just through those activities of about a year and a half of working for him. So I attended bar Thursday, Friday, Saturday night. Had 12 credits, which isn't a heavy load at school. So I had a lot of time during the day to be around him and be in his business and learn what he was doing. And so that was really it. That kicked it off. That was 19. So at the age of 20, I bought my first property with some bartending money I had saved up, as well as one of his relationships I had, in his network, I got to know his one private investor, private lender, and they helped fund the first project. So they kind of gave me a hard money loan. I put up some of my own skin in the game, did that first property, and then we were off and running. So I don't like reinventing wheels. I like to kind of
Yep.
see, hey, the system's working. No need to reinvent it. No need to fix what isn't broken. And so I just modeled what he had taught me. And in my early 20s, built up quite a big portfolio of single family properties, and then morphed into smaller multifamily complexes. And then just started dabbling in different things. Bought some industrial, which it wasn't sexy back then. It wasn't a cool thing to do. Bought some retail,
Uh-huh.
bought some office, bought some medical office, but, but just was trying to find what I felt was a even more scalable model, and commercial seemed to be it. Um, Fast forward, 2008, I pretty much lost everything down here in Florida that
Yeah.
I'd owned, went through the recession and had to go through a rebuild phase. So about 3 years went by of just damage control. 2008, 2011, didn't buy anything, just kind of tried to manage, keep my head above water and work through the damage and chaos that was happening. But 2011 was really like kind of the version two, and it kind of brings us to today. And the fire got relit. I started kind of going out and figuring out what the next step in this journey was. How was I going to rebuild this? And I met a gentleman by the name of Randy, who happened to own mobile home parks. It was never on my radar. It was one of the asset classes I'd never considered.
Yeah.
I didn't know anybody that owned one. It was never talked about, and they were all around me. But
Mhm.
I never had really considered it. It wasn't like one of the main food groups in real estate. And so I met with him for lunch, and after that 2 hour lunch, I was I was like, I'm hooked enough to where I'm going to go learn about this and buy one and see if it's as good as what Randy says it is. So anyway,
Yeah.
it took me about a year to buy one. That was 2012. Bought my first park, and now fast forward, we've owned in 18 states. Today we've got about 3,400 lots under ownership and management. And then on top of that, as we talked about before we started recording, we also kind of not veered off, but added in another vertical to our business about 4 years ago, which is parking. So they've
Mhm.
got a lot of similarities. Our mobile home parks folks park their mobile home there. It doesn't move ever, but it's parked there. They rent the land from us. And then in parking lots or parking garages, folks obviously drive their vehicles and either rent it for a few minutes, a few hours, a few days, a few months, and pay us for the space that they're renting. So lots of similarities, lots of carryover. And those are the two things that we specialize in today. And I've had a lot of fun doing it.
And I'm kind of smiling because I'm like going, man, I like the fact that like the parking lot doesn't have tenants, and that's what kind of attracted me to hotels. It's like, oh man, just being a landlord. But you don't have the services, like the plumbing, all these other things that could go wrong in parking lots. It's just you just got to reseal it and
Yeah.
and take people's money. Um,
Yeah, it
well,
could be a little bit more complex than that in the park. Surface parking lot is just asphalt lot. You are correct for the most part. There's really
mhm,
not much there other than asphalt and maybe some curbing and restriping, potholes that pop up here and there, and then some
yeah.
equipment if you've got pay equipment. But garage is a little bit of a different animal, depending on where you own them. Like I said, we own something in Phoenix.
Hmm.
Phoenix weather, just Arizona weather is very friendly to concrete and steel. I mean, it's not corrosive. You guys don't
Yeah.
get much rain there. And so the garage that we own there is, I think it's 65 years old and it looks fantastic. It's the concrete's in great shape, the steel's in great shape. And but if you take that same garage and put it up in Minneapolis, within 20 years, it would be, probably having stress cracks and crumbles and, corrosion internally and things like that. So a lot more upkeep, depending on where you own it. But generally speaking, yeah, they're pretty straightforward and, somewhat easy to maintain.
Hmm.
There's elevators and things like that as well, but generally speaking, pretty straightforward investments.
Yeah. I mean, that's exactly what people want. And, ladies and gentlemen, if you also were listening to Kevin, he's saying that he had mentorship. He even worked for free to learn. And I can't stress how important that is. Don't go to HGTV, watch it for an hour and say, hey, I can become a real estate investor. It may not work for you. You're going to pay for teaching one way or the other. You might as well learn from someone like Kevin, who's been there, done that. You can learn from his mistakes. And why invest on your own when you can invest with Kevin and just be passive? Why were you attracted to mobile home parks? I'm sure a lot of listeners out there that are like going, "Oh my
Yeah.
God, why would I ever?" Why is it such a great investment?
Yeah, so backing up to kind of my, phase two, my rebuild. I was trying to figure out how I was going to rebuild this empire and do it better the second time around. And I thought as though I thought the path that I had already chosen was going to be multifamily. It just had better scales of economy than a bunch of. I owned a few hundred single family homes spread all out 5 counties. It was a nightmare to manage. It
Yep.
was very inefficient with sales and leasing. This is nowadays there's a little more technology to manage that stuff. I mean, you can do virtual showings, virtual lock boxes, all that kind of stuff, and that just didn't exist back then. So
Yep.
it was just a pain in the ass having sales leasing people out there in the field driving from house to house, showing it, locking it back up, all this kind of crap. And so I felt as though I was fairly confident it was going to be multifamily because I'd owned a number of multifamily buildings and they ran smooth, they ran more efficiently. Slightly different tenant base, but all through and through. If it's in a market that has a high demand for housing, affordable housing, like that's it. Like that's a very
Mhm.
good fit. And so that's what I thought it was going to be. And so I went into this meeting with this gentleman, Randy, that owned these parks. I went in just knowing that that's where I was going to go. I was introduced to Randy because he was a banker for 30 years. And get in front of him, I said, hey, just go talk to Randy. He's a good guy, good resource, has a big network and just a good person to put in your Rolodex. That was it. I didn't even know he owned
Yep.
mobile home parks, actually. But during that 2 hour lunch meeting, he kind of like he pivoted the conversation to kind of compare mobile home parks to multifamily and why they were better, right? So that's kind of how he drew the
Yep.
conversation. And one was just the resident base is a lot stickier. The folks own their homes and they tend to stay quite some time, sometimes decades, right? Just like they treat it just like a single family home. And so in
Yep.
fact, we've got many residents in some of our communities that have been there for over 50 years. And so that was attractive to me. Whereas an apartment, average tenancy is what, 12 to 18 months. And it's pretty easy for folks just to get up and leave in an apartment, right? If they decide that they don't want to stay anymore, they can put the mattress on the roof of their car and fill their car with their belongings and be out in the middle of the night. So, and that wasn't as easy with mobile home parks because these homes, while they're mobile, they're not very mobile. They get strapped down, they get anchored to the ground, the wheels come off, they get blocked up. And so they typically don't leave when they move into a community. They typically stay there forever. So that was a big one. Just the turnover was a lot lower, but that in turn creates lower ongoing maintenance and just
Yep.
expenses that are associated with running the operation. Another big one was just who's responsible for what. They own their own
Mhm.
home, and so if their roof leaks, if their plumbing leaks, if their HVAC breaks, they're not calling us. It's not our responsibility. They're managing it just
Oh,
like a
yeah.
homeowner would, and so that's a big piece of it. Um, those are there's a lot of others. Those are the big ones that really caught my attention. But, one of the other big ones I think that really pushed me over the edge was like, and this is changing very quickly. 10 plus years ago when we started buying the stuff, 12 years ago, more exactly. It was a very fragmented space. There were some big operators, but very few. So lots of mom and
Mm.
pops and there's a lot of inefficiencies that exist when just the original developers own the thing for 30 years. They kind of just they're not necessarily keeping up with market rents. They're not
Mhm.
keeping a very close watch on expenses, and they're just not running it fully like a business owner might be running it most of the time. And so he really pointed out a lot of inefficiencies there and the opportunity to go in and do things better. Just whether it be billing back for utilities, very commonly when a lot of these parks were built, water and sewer just wasn't a significant expense, and so commonly how these things were managed is that if someone's going to pay $300 a month lot rent, that also included water, sewer, trash, and then the
Yeah.
landlord basically covered that that
Yep.
that overhead of that expense. But guess what? When people don't have to pay for, while trash might be a fixed cost, water and sewer is not, right? It's based on usage. And if someone doesn't have to pay for something like that, number one, utilities are expensive now. Water and sewer is a very expensive commodity. And if someone doesn't have to pay for it, they tend to abuse it, right? You got people that
They
have
do.
flappers in their toilets that have been running for months or years, right? Just
Yeah.
wasting, thousands of gallons of water, or they take
Yep.
hour
They
long
don't care.
showers, all this stuff. And so
Yep.
that's a big lever for us. So we'll go into communities. Where they might have a $150,000 annual water bill, and we'll go in and install meters at each individual site, and then basically read the meters on a monthly basis and bill it back accordingly to each person's usage, and literally be able to drop that savings to the bottom line. I mean, that literally
Wow.
comes off the expense side of the P&L, just by doing that one lever. There's multiple other levers like that are fairly common when you take it over from an old mom and pop. But really, he piqued my interest in it for a number of ways, and again, set me on this journey to go basically buy one. I was like, I kind of committed to buy one, and I did. It took me about a year to buy one, but I bought the first one in 2012, and here we are today. So owned assets in a lot of different states, and I don't have, I think probably about 50 parks in total. Going full cycle on
Wow.
about 20 of them. And it's been a fun ride. Learned a lot along the way.
Absolutely. And it seems like because it's affordable housing, that mobile home parks tend to be a little more recession proof. They're a little more, than like an A-class property or,
Yeah.
hotels and other different things. Seems a little bit better. Would you agree? Or
Yeah. Yeah, no, I mean it is. I mean, you could we own yeah, there's like three quality standards I would say, and this is applicable to apartment complexes and even single family home subdivisions,
Mhm.
right? You got kind of the wrong side of the track,
Mhm.
like no one wants to be there, bad part of town, and and mobile home parks are there, apartments are there, single family homes are there, and then you got like kind of the blue collar area, hardworking blue collar professionals,
Yep.
just they want their kids to go to good schools. They want to do the best, but they're working at Walmart as managers or just service jobs.
Mhm. Yep.
And then you got the wealthy part of town, and there's A-class, brand new, expensive apartments. There's executive style homes there.
Curious about growing your wealth, you know the best opportunities aren't always the most obvious. That's why we've partnered with Bob Bernatas of Franchise with Bob. He specializes in helping investors like you leverage franchising, an overlooked but highly profitable way to create semi-passive income. And for a limited time, Bob is giving our listeners access to his course on franchising investing for free. Inside, you'll learn how to evaluate franchises, minimize risk, and maximize returns. This course is normally priced at $499. Don't let this pass you by. Go to edu.franchisewithbob.com/RG and get your free course today.
And even then, there's mobile home parks in that side of town, right? They might be more 55 plus retirement type
Mm-hmm.
communities. You guys have a lot of those out in Arizona. They're not
Yeah,
necessarily affordable. Some might be, but a lot aren't. They're like lifestyle communities. They've got 3 swimming pools. They've got
yeah.
activities directors. They've got shuffleboard. They've got golf. They've got all this stuff, right? And they're expensive. It's not poor
Mm-hmm.
people that are living there. We tend to fall in the middle of that camp. And so how I like to say this is that we want to buy communities that are in the good school districts. They're in good parts of town. They have people that desire clean, safe, and affordable living option. And if you take any mobile home park that we own in any state and you compare it to the what would be the comparable, call it B class apartment community, right? Something that was
Yeah,
built in the last 20, 25 years.
yeah.
Almost always you'll find that our communities are to live in our communities about 30% less than what it would be to live in the comparable apartment unit. And typically our units are bigger. They're on average about 1,100, 1,200 square feet in size, 3 bedrooms, 2 bathrooms. And so if you can't afford to live in one of our mobile home communities in that respective, whatever market it might be, there's truly not a more affordable option. I mean, you might be able to go find like a studio apartment in the wrong side of town,
Yeah.
and cram your entire family into it, like that might be an option. But truly meaning like a normal size unit, we are the best, most affordable option. In fact, most of the time, our units are actually nicer than that of what you might get in that comparable B unit apartment complex.
Mm-hmm.
I mean, these units they use the same standards that they build stick built homes with now. I mean, literally the fit and finishes on the inside of these newer homes.
Oh, yeah.
I mean, the same, types of, countertop material, cabinet material, flooring, all that. They've got central heat and air. I mean, they've got LED lighting, all that. I mean, so like you get a lot of bang for your buck. And it's just, if you can't afford to live there, there's really not many other options for you to live. There's not. And
Yeah.
so even that trickle down effect happens. If you can't afford to live in that B class apartment, or if we're renting a house, now we get this trickle down effect. Like the buck all kind of stops in these mobile home communities. And it's a great option. So we do great when times are good, and we do
Yeah.
even better when times are bad. So
Yeah.
we don't see periods where we go through we've never had to give out concessions like move in, get two free months or anything like that, or free
Yeah.
big screen TV. That just doesn't exist in our industry at all, because what we have is in high demand and there's not a lot of it. So
I mean, ladies and gentlemen, that's why you see that, a lot of people, when they go from fix and flip to single family tenants, and then most people want to get into multifamily, and this is just another way, another avenue, another asset class that might be pretty good. Um, so what's your advice for beginning investors? I always say find a mentor, maybe become an LP or joint venture, partner first, learn the ropes. What is your best advice for beginning investors that are listening now and say, man, I have maybe one or two rentals. How do I grow? What's going
Yeah.
on?
I mean, I think it's a couple ways that we can approach this. I mean, I think first and foremost, there's a lot of information out there. I mean, for anyone that
Mhm.
has an excuse of like, I don't know how to do it, or I can't figure it out, bullshit, you haven't looked hard enough
Yeah.
because like there's an overwhelming amount of information. And most of anything you want to learn nowadays I don't care if it's real estate investing or stock market trading
Yeah.
or learn how to be a DIY electrician and any of that stuff. Like literally you can get about 95% and probably 98% of the way there. You might not have the
Hmm.
certification or the paper that says that you're legally allowed to be doing what you're doing, but you can learn it between,
Yep.
podcasts, between that and YouTube. Really, those two things alone, the information's there and most of it is free and it's readily accessible. So, um,
Yeah.
with that being said, all of us learn differently. For me, I have to actually do. I can watch videos, I can listen to podcasts and
Hmm.
all that, but I learn a lot better by doing. And so for people like me, maybe it's a hey, like learn the basics. Spend time diving into podcasts and YouTube videos, but then really
Hmm.
hone in on a few people that like they're doing what I'm doing. They're already years ahead of me, but then identify where I might be able to add value to their business. I mean, and I don't know what that means for you, right? Like whoever's listening here, like what's your unique skill set? What do you do well? And
Hmm.
how might that be applicable to who's, doing what you want to be doing? Like they're 5 years ahead of you and you might be able to help them, in their growth trajectory, but in the intern, they can help you learn the basics of their business and how they've built what they have. And so I think that opportunity exists. You gotta figure out what value proposition you bring to the table. It's not, I mean, again, I get a lot of people that reach out to me. I'm sure you do as well. They want to like, hey, how can I, pick your brain or this, that, and
Hmm.
the other? Like, here's what I
Yeah.
want. It's like you better like make yourself stand out, find out, learn a
Hmm.
lot about that person, and then find out how you can your one little unique thing that you do really well, how can that be applicable to their life and actually make their life better, right? Because they're already way ahead of you already. So like you got to figure out a way to create a compelling pitch for them to even want to listen to who you are and what you might offer and how that could benefit them. So, but I think just again lining yourself with individuals that are doing what you want to do, and that also might not just be one person. That might be a group or a community of people that are where you want to be, that are talking about it, that are around it
Hmm.
all the time, that are just living and breathing it on a daily basis. And again, there's no excuse to that either. I mean, you can go to meetup.com or the many other, venues to find out where these live groups happening on a
Yeah.
on a weekly or monthly basis in my immediate marketplace. And guess what? If you live in a small town and there's not one happening there, drive an hour and a half to the next biggest town where there's one happening, right? Like so I don't take excuses lightly. There's a where there's a will, there's a way, and
Hmm.
the information is out there and it's available for you. Again, most of it being free. So utilize it, leverage it, and make shit
That's
happen.
right. That's right. Yeah. Yeah. And yeah, I got started, I call it the PG days, pre-Google days.
Yeah.
You know, buying a house was easy, how to be a landlord. I'm like, well, I can't Google it. So ladies and gentlemen, you don't have an excuse. Us old people that got started way back when in small towns, we might have a little bit of excuse, but I kept it going and learned from the mistakes. Um, Kevin, let's talk about what you have going on now. Any syndications, funds, your website, people go on, how do they find out and say, you know what, I want to get into it. I want to learn. Um, what do you got going on now?
Yeah, I mean, we operate funds, Reg D 506C offerings, accredited investors only. We've been operating funds now for, I guess, about 10 years. Um, we do have a current offering open. We opened it up towards the end of last year. Currently it's a $100 million fund. It's got about over 100 and I think about $120 million worth of assets in it. And we'll probably, work to wrap that fund up sometime next year. But we always have a new fund. We always have one kind of coming behind it. I mean, we're steady in our growth trajectory. We've got big goals. What we want to buy makes sense, and we take our time and we're patient with finding the right deals that fit our portfolio and fit our buy box. But again, most of our capital comes from high net worth accredited investors, folks that are successful in other areas of life. They might even be a real estate investor. Maybe they just figured out they don't want to do it personally. They don't want to do the dirty work, right? They don't want to build a real estate company. They don't want to be in the trenches. They don't want to be going on site to properties and dealing with all that stuff. So that's what we do. We have a vertically integrated property management company that manages the day to day, and we're really good at finding great opportunities and great markets, and really putting forth the operational, magic to turn it around, like buying in the right areas, but being able to breathe new life into a community, which typically equates to investing a lot of capital, lots of dollars back into it, redoing roads, redoing infrastructure, amenities, bringing new homes into these communities and just breathing new life into them. So, but investwithsunrise.com, that's the best place to learn more about that. Our company is Sunrise Capital Investors. You can get a lot of details there about the current offering, as well as things we've historically done. We've got a lot of information there, so you can learn quite a bit about us and who we are, what we do in the manufactured housing, and also the parking space.
Yeah, are these generally long-term holds,
Yeah.
5 to 7 years or longer, or what's a deal
Yeah.
look like?
Well, I'd say that we've gone full cycle on quite a number of deals. However, both mobile home parks and parking are a unique asset class in that they're not really making more of them. So,
Yeah.
what we have found that every year that we sell something, it becomes inherently more difficult for us to find a good, solid replacement property that can meet those same, return metrics. And so while we might have a big exit and everyone's happy when they get checks, every time we've exited, it also creates a capital event, which also creates a tax event, right? And so
Right.
it's good to get big paychecks. It's good to take chips off the table. However, we've determined that our business model is really morphed more towards long term. We have a long term vision, 10 plus years. So everything we
Yeah.
buy, not saying that we won't sell anything, but we
Yeah.
like to take a look at it as, will we want to own this not just in 3 to 5 years, but do we see this being a great fit for our portfolio in 10 plus years? And so our investor base is very much, they're very much in alignment with that. So like our ideal investor who brings money to us is that, hey, Kevin, I just really want the mailbox money.
Okay.
You don't necessarily, I'd love for you to hit it out of the park, but I'm not I want wealth preservation. I want good assets in great markets. And I don't necessarily want you calling me every 3 to 5 years telling me that you've sold something, because while you sold me on the tax benefits on the front end, now I got this depreciation recapture and I've got an even bigger problem in my hands 3 to 5 years down the road. And that's real.
Yeah.
Like, everyone like to say, well, if you pay a lot of tax, that's a good problem. You made a lot of money. Like, that's kind of bullshit. That's not a good excuse. And so we really have morphed our focus onto more longer term holds and finding our investment, group that has that longer term vision. They're not trying to hit, triples and home runs now. They just want singles and doubles, and they want that consistent cash flow for a very long time, but have it being held in, physical assets that are in a great market and great locations. So again, and those are very hard to replace because they're not making more of what we buy. So when we find it, we like to hold on to it for as long as possible.
Yeah. And that's very similar to hotels. It's more of a business, right? I mean, it's people say, hey, you put lipstick on it. I'm like, no, it's hotels a little bit different. It's not a fix and flip. Very, 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 very few. And it's like, yeah, it's the same, ladies and gentlemen. If you're looking for diversifying your portfolio, and a lot of my investors, a lot of Kevin's investors are the type that they don't really necessarily want that quick thing. They don't need more cash flow, right? I mean, they want a long-term hold and just something that's safe down the road, and just a few bucks here and there.
Or if they might want cash flow, but it doesn't need to be like 12%, right, on an annual basis. They're okay. Hey, give me 6%. Knowing that also there's a lot of sweat equity that's being built there. It's an asset that's irreplaceable. It's going to inherently grow in value over the years and decades that we own it. And so like that's again, don't get me wrong. Like when we started off, we always felt as though everyone was driven by the highest returns, and that's great. Like hitting massive home runs or grand slams, like it inevitably happens no matter what you do. Like you're going to find one every once in a while that's just a rock star of a deal,
Mhm.
and that's great and all, but it's really hard to go back and replace that again and again and again and again,
Yeah.
especially at least in our asset class. Maybe it's a little different, like multifamily, because there's so much new supply always coming, right? Like that's just not the case in the two asset classes that we're investing in. They're not
Mhm.
making new parking, and they're not making new mobile home parks. In fact, both those asset classes have a diminishing supply, and so the
Mhm.
supply is continually going down and down and down, which creates more demand for it, but also
Yeah.
there's more competition buying those assets, and so makes it harder for us to go out and find the next great one, the next great one. So we like to keep what we have.
Yeah. Kevin, where else can people find you before we leave?
Yeah, I mean, you can go on any I'm very active on LinkedIn, Instagram, Facebook, and my last name's fairly unique, Bupp, it's Bupp. So if you just type in Kevin Bupp, you can quickly track me down. And then my personal website, kevinbupp.com. There you can just learn more about me, a personal level. But I also host my real estate investing for Cashflow podcast there. It's a commercial real estate investment podcast. We're going on our 11th year now, so got quite a number of episodes up there, and can download those there, as well as iTunes and Stitcher and
Yeah.
Spotify, wherever else folks download podcasts. So
Is there anything else that maybe I haven't covered that you'd like to tell our listeners?
no, I don't think so. I think we covered some good ground. I appreciate you having me on. I appreciate what you do here, and yeah, you did a great job. So, and just keep it up. I mean, like really, this is, we talked about like getting information. I mean, this is it. This is how folks. I mean, because of folks like you and me and others that host podcasts are putting out quality information for free. Take advantage of it.
That's
All
right.
it is time for you, right? Like not for you, meaning, but for the listeners. All it is, it's your time. Your time is valuable, but if you're learning
Right.
something valuable, then I could promise you it's well worth it.
And most of us have a commute, so just pop it in, listen to
Yep.
it, stream it in the car. Kevin, thank you so much for coming on the Richer Geek podcast. Have a wonderful night.
Thanks, Mike. Thanks for having me.